very, very welcome to Grant Thornton's offices this morning for our international tax update for investment funds. For any of you who don't know me, my name's Niamh Meenan and I head up financial services in Grant Thornton. We've run this seminar now for several years and it always proves to be a popular and timely event. There's something about tax that gets people interested. And it's certainly true that keeping up with changes in international tax, both for the funds and the investors, is a challenge, but it's also a key part of us maintaining Ireland's reputation as a centre for excellence for servicing Irish and offshore funds. And our speakers today bring a wealth of international expertise to us. We start off with Paul Beecy, who makes a welcome return from Grant Thornton in Boston. Paul is a tax partner there who specialises in financial services and also a host of transactions where there is any kind of cross-border element. Paul will be followed by Peter Vale, who's a tax partner here in Grant Thornton, Dublin. Again, Peter has many years' experience in financial services and also in a lot of international transaction and has a range of international clients. And finally, we've Anne Stopford, who's head of funds tax in Grant Thornton in London. Anne is a member of the AIMA Tax Committee and is also a regular visitor here in Dublin. She has a wide client range, both of funds and of investment managers. And all of our speakers today are very experienced in providing tax advisory and compliance services to funds that are administered here. Given the popularity of the US and the UK for funds, with the fund managers being resident there, we find that working very closely with our associates there is a key part of our work here.
For most funds, unless you've got Irish tax resident investors, Irish tax isn't a major issue. And even for a lot of the tax structuring that we do, essentially you're trying to plan around overseas taxes. So even though you might be looking at the Irish tax treaties, what's really at play is the overseas tax. It could be German tax, Spanish tax, Australian tax. So Irish tax, typically you might say, well, it's not really an issue for funds. What we're going to focus on this morning is a couple of areas that are of Irish tax, that are of interest to funds. And they're areas that are under the spotlight at the moment, as in the Irish Revenue are specifically probing these areas. And I'm talking about VAT and payroll taxes, essentially. The good news is there's only 3 slides, short and sweet, but it's a key area. So the first area we're going to have a look at is payments to directors and POE, PRSI. And the issue essentially here is what's done in practice and what the legislative position is. So if you think about a director providing director services to a fund, traditionally what happened there was the director would raise an invoice to the fund, probably VAT inclusive, and the fund would pay the director whatever the amount was inclusive of VAT. So there wasn't any payroll tax deducted. And that's been a long-standing practice in a lot of funds, but per legislation, tax should be deducted, payroll tax should be deducted by the fund. So that's one example. Then you might have a non-resident director, and you might say, well, look, he's a non-resident, he's resident in a treaty country. Surely there isn't any tax obligation here. Surely under the treaty we can get out of a payroll tax. Maybe we can get an exclusion order in place. The reality is, if you look at the tax treaties, Ireland's tax treaties, typically the payroll tax liability rests with the Irish entity, with the fund. So even if it's a non-resident director, you can't get out of the Irish payroll tax obligation. Then you might have a situation where the director provides invoices via his own company, his or her own company. So you've got an invoice now from the director's company to the fund. Again, no payroll taxes, just a VAT inclusive invoice going to the fund, and the fund pays that over. And you might say, well, is that okay? The invoice is coming from a company. You can't deduct payroll taxes from a payment to a company. Now, the issue is, of course, that what Revenue will say is they'll look through that and they'll see the actual director of the fund as effectively mandating his director's fee to the company. And the position there is that there's a payroll tax obligation again on the fund. You can't get around it by simply invoicing it via another entity. That's the technical position. Then you can have another position whereby you might have services provided by a professional firm of accountants or solicitors or whatever. So they invoice the fund. Again, you might say, well, look, it's not really practical to be deducting payroll taxes in those situations. And you can apply to Revenue and get effectively what's akin to an exclusion order not to deduct payroll taxes from the payments to the professional firm. But in the absence of having that exclusion order, again, technically there's an obligation on the fund to deduct payroll taxes. And you might say, well, that's madness, and in practice it's an administrative nightmare to have to do that in all situations, because you can have several different funds and several different service providers. But technically, that is the position. So you have this disconnect between what's in the legislation, what people are doing in practice, and then what is actually practical. And many of you here will be involved or will know of the various technical committees that are concerned, and we're all concerned about the issue. What's hoped for is some clarity from revenue on it. What we hear is that in the absence of any clarity, one option is just to defer making those payments until there is a bit of clarity. And I think because it's more in the spotlight now, it's incumbent upon revenue to give some sort of clarity on this. So that's one of the issues that's out there. VAT, we're certainly seeing more interest from revenue on VAT. To note, you're probably aware, there is an obligation to register for VAT if you're receiving services from abroad. So there may not be any VAT on the invoice you get from a UK provider, UK service provider, but you have to self-account for VAT in Ireland on that. And in many cases, that means there's an irrecoverable VAT for the Irish entity, for the Irish fund. So there's a NAV implication there. There can, of course, be recovery of some of that VAT depending on the situation. Typically, where you look at your non-EU assets versus EU assets, and it's often overlooked. And we've had a number of clients that have got fairly substantial VAT refunds from trawling through the paperwork and just analysing where their funds are split, where their assets are split. And it typically is done on the basis of assets as opposed to investors. It's the more practical way of approaching it. We had a case a couple of weeks back where there was a refund of close to 300 grand where a fund had US assets. So it is worth, if you haven't recovered any VAT in the past, it is something worth looking at. There can be large unrecovered VAT sitting there potentially on the balance sheet of the fund. Just to note that certain services supplied to a fund can be VAT exempt. So in that case, you don't have to self-account. So if you are doing that, maybe you're paying too much VAT, just to be aware of that. So investment management services are the classic case there. This is the last slide. Just talk very briefly about other issues and maybe if they're relevant to the fund sector. I think we had a session yesterday. It wasn't a fund-specific session on shared services, and the Minister, Richard Bruton, was speaking at it. And one theme that came out, and it was in context of shared services, so a lot of MNCs who are in Ireland, and we're talking about the tax regime. And the word uncertainty kept coming up, and nobody likes uncertainty. We need certainty about the tax rate, and I think that is relevant to the fund sector, because if you don't have certainty about the 12.5% rate, who's to say where things might end up for the fund sector? So what you'd like is certainty as to what's happening with Ireland's tax rate and with other aspects of our fiscal profile. I think the corporate tax rate, the 12.5% rate, has been pretty much put to bed at this stage. Of slightly lesser significance is the common consolidated tax base, which is another, effectively a backdoor perhaps to a hiring of the rate, or a negative on our tax position, which is that effectively you look at the profile of a company's profits in a different way, working at taxable profits, and you base it on customers, etc. And clearly that wouldn't be of interest to most Irish MNCs where they don't have many Irish customers. And hence, if you based your profits on customers, you probably have a much lower profit base in Ireland, and hence you're probably paying tax at a higher rate somewhere else where the profits will be attributed to. So that's still on the table, the common consolidated tax base. So it's not as critical, I think, in terms of Ireland's tax profile and relevance to the fund sector, etc., because it's more of a European thing, whereas the 12.5% rate is an Irish-specific issue. And I think that is a positive that has been pretty much put to bed at this stage. There's been lots of talk about how France's rate might be in the 30s, but the effective rate in France is actually about 8.8%, whereas our rate is 12.5% headline, and the effective rate is, I think, 11.9%, so pretty much equivalent. And I think that has helped effectively let us move on. I think most jurisdictions, most other countries have moved on from it now as well. Another issue which is relevant for the fund sector is trying to get key people over to Ireland, senior executives, to base themselves here. And other jurisdictions do have tax breaks for such individuals as a way of attracting them to Ireland. I think it's an important part of our armoury, with an FDI hat on. So I think it'd be very welcome. If there is at the moment, there is a tax break there, but it's quite limited, and I think it'd be very welcome if that was improved. I think when you are making payments, I think what we're seeing is people are looking closely. I look at, is there any way of structuring payments, perhaps to get a capital gains tax rate. At the moment, the CGT rate is 25%, your marginal income tax rate is 52%. So if you can structure remuneration packages in such a way as to move towards capital as opposed to income, you're going to get a substantial saving there for the individual, which can be shared with the fund or with the company. So I think there are just a couple of topical issues at the moment. And that's all from me.